Welcome, focused learners, to The Explainer. Today, we have a really fascinating mission ahead of us. We're taking a deep dive into the real estate sector, and we are putting Four Corners Property Trust, ticker symbol FCPT, through the absolute ultimate fundamental analysis gauntlet. Using their freshly released Q1 2026 data, we're going to tear down the numbers, strip away all the market noise, and see if this company can actually survive a rigorous, multi-stage investment evaluation. So, if you love structured, objective analysis, you are in exactly the right place. Let's get into it. I want to hook your attention right out of the gate with this quote from FCPT's CEO, Bill Linehan, straight from their Q1 earnings release. He confidently describes their holdings as a fortress portfolio that gives them the ability to play offense. Now, that's a pretty bold statement in today's macroeconomic environment, right? But our job today isn't just to take his word for it. We're going to test those walls. We are going to see if this so-called fortress truly holds up under the intense scrutiny of the most legendary investing frameworks ever created. Here is our game plan for today. First, we'll meet FCPT and establish our Q1 baseline. Then, Trial 1, the quantitative gauntlet. Trial 2, the oracle's interrogation. Trial 3, the linchpin test. And finally, we'll tally up the scorecard for our overall verdict. Okay, Section 1, meet Four Corners Property, the Q1 2026 baseline. Let's establish exactly what we're evaluating before we start running these models. Let's look at FCPT's massive footprint. They just reported $78.2 million in total revenue for the quarter. But the really crazy number here is that 99.6% occupancy rate across 1,313 properties, that is an incredibly high, stable baseline, mostly made up of restaurant, auto service, and medical retail locations. They also just secured a new $200 million delayed draw term loan to fund future acquisitions, and they are locking in their tenants with a 6.7-year weighted average lease term. Basically, this paints a picture of highly visible, highly predictable cash flows. Moving on to Section 2, the quantitative gauntlet. We're crunching the Q1 numbers through 5 distinct valuation models to find FCPT's true intrinsic value. First up is the dividend discount model, or DDM. This model assumes a stock's true value is just the sum of all its future dividend payments, discounted back to today. And honestly, it's perfect for a REIT like FCPT. Looking at their profile, this company is a remarkably reliable cash flow machine. They recently declared a 36-ish cent quarterly dividend, which annualizes to $1.47. That generates a massive 5.83% yield. Assuming their cash flows stay stable, which, come on, that 99.6% occupancy heavily suggests they will, the DDM indicates the stock is currently offering a really attractive, undervalued entry point for income investors. Now, I want you to think about this single, bold number, 5.0x. This represents our second model, enterprise value to EBITDA, which basically measures how leveraged the company is relative to its core earnings. For real estate investment trusts, you'll often see leverage ratios climbing way up into the 6s or 7s, but FCPT's net debt to adjusted EBITDA sits exactly at 5.0x. This is a phenomenally conservative leverage multiple. It places them at the very bottom of their target range, signaling a highly secure balance sheet that's arguably undervalued relative to its riskier peers. For our third model, we typically look at price to earnings. But here's the catch. With REITs, standard PE is frankly deeply flawed. Heavy accounting depreciation artificially lowers their earnings. So our assumption here is that we have to use adjusted funds from operations, or AFFO, to see the real cash. While their standard PE looks a little bit rich at roughly 24.9x, the price to AFO paints a completely different story. With 45 cents in quarterly AFO, their multiple drops down to a very reasonable 13.8x. For a portfolio with this level of stability, 13.8 times cash flow absolutely signals that the stock is fairly valued. Model number 4 is the price-to-book ratio, which compares market value directly to accounting value. FCPT's book value per share is roughly $15.16, trading against a market price of around $25.04. That gives us a P/B ratio of roughly 1.6x. Now, our key assumption here is recognizing that real estate accounting requires aggressive depreciation of physical assets over time. So the accounting book value almost always drastically understates the true market value of the actual physical properties. Because of that, a 1.6x price-to-book ratio is entirely standard here, and again, points to a fairly valued baseline. Our fifth and final quantitative model is a really cool one, the reverse discounted cash flow. Instead of projecting future growth to find a stock price, we take the current price and solve backward to see what kind of growth the market is already assuming. And this brilliantly illustrates how rational the market is right now. The reverse DCF implies the market expects steady, low single-digit growth. Well, when we look at FCPT's actual Q1 results, their AFFO per share growth was exactly 3.4%. The market's expectations and the company's reality are in perfect harmony, indicating the stock is fairly valued. So let's summarize the quantitative gauntlet. We've run 5 distinct models, and here is the scorecard. EV/EBITDA and the dividend discount model suggest the stock is leaning toward undervalued due to those high yields and conservative leverage. Meanwhile, the PFFO, price to book, and reverse DCF models all signal that the stock is fairly valued, accurately priced for its steady growth. Concluding trial 1 purely on the math, the stock sits squarely between fairly valued and undervalued. We're seeing absolutely 0 red flags in these numbers. But as we know, math only tells half the story. Section 3, the Oracle's interrogation, Warren Buffett's checklist. Let's see if FCPT can survive a qualitative interrogation. The very first question Buffett always asks is this an understandable business? And does it have a durable competitive advantage, also known as a moat? Basically, do we, as laypeople, understand triple net leases, and do they actually protect the business from competitors? The answer on simplicity is a resounding yes. They own the real estate under 180 different restaurant and retail brands, and they collect rent. That's literally it. But what about the moats? Well, the crucial point here is their sheer predictability. In Q1, they collected 99.7% of their rent. Furthermore, on their legacy Darden properties, we're talking places like Olive Garden, the tenant has a 5.8x rent coverage ratio. That means the restaurant is generating nearly 6 times the cash it actually needs to pay the rent. That creates a massive, undeniable margin of safety. Next up on Buffett's checklist, are they drowning in debt, and is management shareholder-oriented? Because as we know, a great business can be totally ruined by terrible capital allocation. Fortunately, Buffett would absolutely love the safety here. We already established their super low 5.0x leverage, but even better, in a highly volatile interest rate environment, 100% of their outstanding debt is locked in at a fixed rate all the way through November of 2027. They are completely insulated from near-term rate shocks. On top of that, management continues to rationally allocate capital, dedicating themselves to steady shareholder returns with that declared Q1 dividend. They easily pass the Oracle's interrogation. Section 4, the linchpin test. Now we are applying Peter Lynch's logic. Lynch was famous for finding hidden gems in the most boring places imaginable. So let's see how FCPT measures up. The very first thing we have to do in Lynch's framework is categorize the company. FCPT perfectly fits his definition of a stalwart. It is not a fast grower. It's not going to double its earnings overnight, and it doesn't pretend it will. Instead, it's a large established company offering steady, predictable growth and incredible downside protection. It's a slow and steady fortress. Let's visualize what stalwart growth actually looks like using the latest Q1 data. Year over year, we see AFFO per share up 3.4%, FFO per share up 4.7%, and overall rental revenue up 10.0%. While Lynch often used the PEG ratio, price to earnings growth, for fast-growing tech companies, he acknowledged it isn't quite as relevant for a stalwart. Instead, we just want to ensure this steady, single-digit cash flow growth perfectly supports their 13.8x multiple, and frankly, it absolutely does. Now, Lynch had a famous list of attributes for what he considered the perfect stock. He loved boring, unglamorous companies that Wall Street just tended to ignore. So, does FCPT check these boxes for the ideal boring investment? Let's check them off. Is it a boring business? Yes, owning the concrete under an Olive Garden or a local tire shop is about as boring as it gets. Is it understandable? Absolutely. Literally everyone understands the concept of a tenant paying rent. Debt to equity ratio? Well, if we take their $1.28 billion in total liabilities over their $1.66 billion in equity, we get a highly reasonable 0.77. And because they just own the real estate on triple net leases, there are 0 inventory risks, nothing sitting in a warehouse going obsolete. FCPT easily clears the linchpin test. Section 5, Summary and Final Verdict. We have successfully run the entire gauntlet. We've crunched the math, we channeled Warren Buffett, and we applied Peter Lynch's logic. It is time to tally the scorecard based strictly on this comprehensive Q1 2026 evaluation. Let's walk through our final table. On the 5 quantitative models, the stock signaled fair to undervalued, heavily supported by its 5.8% yield and reasonable 13.8x PFFO. On the Warren Buffett checklist, it's a pass, driven by an incredible 5.8x rent coverage and near-perfect rent collection that creates a massive moat. On the Peter Lynch checklist, another pass, sitting quite comfortably as an easy-to-understand, boring stalwart. Therefore, surviving all 3 trials results in an overall, fundamentally bullish verdict. The balance sheet is pristine, the leverage is wonderfully low, and the cash flow is highly secure. I want to leave you with a final, slightly provocative thought. We live in a market that is currently obsessed with high-flying, volatile tech stocks and completely unpredictable fast growers. But when you strip all that away and just look at the fundamental math, you have to ask yourself, is a boring, highly predictable 5.8% yielding property trust actually the ultimate margin of safety for your portfolio? That is exactly the kind of question fundamental analysis forces us to ask. Thank you so much for joining me on this explainer. Keep scrutinizing those numbers, and I'll see you next time.